Hey guys, today we're going to talk about unearned income again, but instead we're going to go a little deeper and point out the 1099 that you've gotten in the mail here in the last couple weeks or months, and what do all those boxes mean? How can you maybe change some things next year to change how you are taxed? Stay with us. Hey guys, Brad Rue here, Action Financial Strategies. Today again we're going to talk about a 1099. What is that mysterious tax document you get every year in the mail and that you just incidentally happen to take it to your accountant and he tells you how much tax you owe? So we're going to walk through some numbers. What do they actually mean? What boxes do you need to pay attention to? And how maybe setting things up a little differently could change how you're taxed on already what you're doing financially. So stick with us. What do those numbers mean? So I'm going to reference some stuff. You're going to see the 1099 box pop in here a few times, as well as some math. So try not to get super detailed on the math. I'm not an accountant. I don't pretend to be one on television. But there's a couple boxes that I'm going to point out. First is box 1A. It's a very top box on that 1099. And in that box 1A, you have total ordinary dividends. What is that? Well, that includes all qualified dividends, all non-qualified dividends, and any net short-term capital gain distributions from mutual funds or real estate investment trusts for the small minority people that actually own those. It also includes taxable income from mutual funds, not just dividends, okay? So we'll get to kind of what this would look like on an investment statement, how to figure out maybe which funds and things are generating this for you. But that's going to be the biggest probably amount you have on your 1099. There might be some other amounts here shortly that are bigger depending if you bought or sold things. The next box down is box 1B. That is qualified dividends. Okay, so these are dividends paid by a U.S. company or qualifying foreign company, and generally they're at a lower rate of tax than your ordinary dividends up in box A. So a little bit of difference. Again, we'll show you how to kind of calculate those. If you take a look at box 1A and you subtract box 1B, we have non-qualified dividends. So these are the things that are typically interest that you're getting from various investments. They're taxed as ordinary income and often at a higher rate. So we have some that are taxed at a little bit lower rate and some that are taxed at a little bit higher rate. So we'll get into that here in a second. The last item on this box that I'll point out is box 2A, and this is capital gain distributions. Basically, if you sold something throughout the year and you had a gain, this is where it would be reported. Whether it's a gain from a mutual fund or a real estate investment trust or other things. So those are the three boxes and some of the math on that. Now let's take a look at an example of the average taxpayer. We'll call him John Q. Public or John Q. Average. And some stats on John and his filing status. This is just an example. This is not a real person, but this could very, very likely be a real person out there. So you'll kind of have to do your own math and figure out where you fit. But let's look at an example to kind of really understand the math and how this guy's taxed. So first off, John taxpayer, right, is a $400,000 married filing jointly income. So his marginal tax rate is 35.8%. And how do you get that? Well, you take his 32% tax rate under current brackets, you add the 3.8% net investment income tax, voila, we're at 35.8. John's really feeling that tax. Next, on long-term capital gains, those are the better gains, right? Because the longer you've held something, the more favorable tax treatment there is to it. So the long-term capital gain rate and the qualified, remember I said before the non-qualified and qualified dividends? The qualified dividends are treated a little bit better. And so that tax rate for John, because he's in that little bit higher bracket, married filing jointly, is 18.8%. Now, it's not the 35.8, but it's still a good chunk of money at 18.8. How do we get to that? Well, again, we got the 15% capital gains rate for John, plus that pesky net investment income tax of 3.8. Gives us, voila, 18.8 on those gains. Now, what does he have for investments? Well, John has, we'll call it a stock mutual fund, which is very common. A lot of people own stock mutual funds. And in that equity mutual fund, he's got $350,000. Okay. That equity mutual fund has a 1.3% dividend yield. So meaning there's some stocks in there are kicking off a dividend to them. And a lot of times you can see this on a statement. You'll see the estimated yield that particular holding or fund might have. And his fund, because it turns over throughout the year, it's not tax managed. It had a 10% capital gain disbursement to him. Okay, so keep those numbers in mind. I'll show you that here on this slide. He also has a taxable bond mutual fund. Now, again, we'll use the same numbers. He's got $350,000 in that one as well. And that has a 1.5% dividend yield. So the bonds inside, on average, are generating him 1.5% interest. So what's the tax impact? He's got these two accounts, $700,000. Where are we at? Well, a box 1A, like I mentioned before, are dividends from his mutual fund. So his equity mutual fund that he has that $4,550 of interest income. And from the bond mutual fund, you multiply that out, he's got $5,250 of income. So total ordinary dividends in that first box is $9,800. All right, that's going to show up in box 1A on the 1099. Now, if we look at box 1B, what's just the qualified dividends, those dividends that are treated with a little bit more favorable tax treatment from that equity mutual fund? That's $4,550. So that just goes in box 1B. And then box 2A, we mentioned before, he had that 10% capital gain disbursement from his mutual fund. And so 10% of $350,000 is $35,000. So that'll show up in box 2A. And it'll look something like this. Bing, bing. So pop that up here for you. So this is John Q. Public Taxpayers 1099. Fantastic. So what's that tax impact to him? Well, let's start off with box 1B, the qualified dividends from the equity mutual fund. Remember I said those are taxed at a little bit more favorable tax rate for them at 18.8. So we multiply that $4,500 times 18.8. That's $855 in federal taxes. Thank you, Uncle Sam. Box 1A minus the 1B, right? We have the total dividends minus box B, which is the qualified dividends, gets us those non-qualified dividends, the dividends that are taxed at the slightly higher rate. And we take the $9,800 minus those qualified dividends of $4,500, gives us $5,250. And we multiply that by his marginal tax bracket, plus that pesky net investment income tax, the 35.8, giving us a $1,879 federal tax bill. Thank you again, Uncle Sam. The last box we mentioned before, again, is box 2A, and that is those capital gains. And because we're going to say he held these for a year and there wasn't any short-term gains or anything in here, they were dispersed as long-term capital gains, a little bit more favorable treatment, just like those qualified dividends, taxed at 18.8. So the $35,000 of gain he has to report times 18.8 gives us the $6,580 in federal taxes. So add all that up. Where are we at? Well, right here you can see $855 plus $1,879 plus $6,590 or 80 gives us a whopping ding, 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 $9,314 in federal income taxes, or basically a negative 1.33% of his overall balance. This might not be too much money for a guy making $400,000 with his family and everything, but it's still a tax erosion that costs him $9,314 that arguably he didn't even receive, right? A lot of people have their stuff set up where it just automatically is being reinvested back into the account for growth, right? It goes back to that total return number and contributes to their ongoing performance. But there is a tax drag that still has to be accounted for, and in this case, it's $9,314, or 1.33% of his value eroded to taxes. Well, meet tax-aware Jane taxpayer. Now, Jane's a little smarter. She was able to kind of think ahead and be a little bit more efficient in how she set things up. And she, just like John, is married, filing jointly, and has a $400,000 income. And so she's in that pesky 35.8% marginal bracket, which is that 32% plus that net investment income tax of 3.8. And she's taxed at the same long-term capital gains rates and all that like John, the 18.8%. And her portfolio is largely the same as John's, believe it or not. She has, in this case, though, a tax-managed equity mutual fund, so she's in stocks and everything in there too. Just has a tax sensitivity and overlay and a little bit more strategic style of how it's invested. So her balance there, $350,000, same amount, but instead of that 1.3% dividend yield, her funds are positioned a little differently, and she has a 0.15% dividend yield. And because this account has the tax management overlay to it, it didn't actually disperse any capital gains this year. So she's got no capital gain distribution. And then on her bond portfolio, rather than it being a taxable bond mutual fund, she's in a municipal bond mutual fund, which generally has any income from it not taxed on a federal basis. Now, there might be some state tax, but we're just dealing with the federal here today. So on that $350,000 she has in her municipal bond fund, she has a little bit lower dividend at 0.9%, but that again is generally tax-free. So what are the impacts? What does her 1099 look like from this kind of a setup? Well, back again to box 1A on that 1099, we get the dividends from mutual funds. So if we just did our math, our dividends on our equity mutual fund, 0.15 times the 350,000 is $525. And the taxable interest income from that municipal bond fund is actually zero. We don't have any. Even though it's interest income, we just don't report it on the federal because it's generally tax-free. So her total ordinary dividends are only $525. Now we go down to box 1B. What are those qualified dividends? Well, again, that's going to be from that equity side, the stock mutual fund she has. And again, it's the dividend yield's a little lower. So again, she's only at $525 there. And then box 12 comes in this case, and that's where we report exempt income. So exempt interest dividends from that municipal bond fund are $3,150. So that's that 0.9% dividend yield she has multiplied by the $350,000. So her 1099 is going to look something just like this. Boom, you see it up here. So a little bit fewer numbers on there, right? So what's the tax impact to tax-aware Jane taxpayer here? Well, first off, box 1B, just like before, qualified dividends from the equity mutual fund, those are taxed, right? But because they're qualified, they're at that 18.8%, a little bit more favorable rather than her marginal tax bracket of 32 plus the net investment income tax. So what's 18.8 times $525? $98 in federal taxes. Well, that's pretty cool. And then if we do the math, box 1A, right, the $525 minus box 1B, which is the qualified dividends, we get 525 minus 525 is zero. So she owes zero tax on non-qualified dividends because there wasn't any. And box 2A, which we said was capital gain distribution, because her funds managed tax aware and there wasn't any turnover, she didn't have any disbursement. So zero gains are reported there. 0 times 18.8 is 0. No taxes owed on federal taxes owed on capital gains. And then we add up all those boxes again. What did we have? Well, we had $98 in that first box on those qualified dividends, plus 0 equals $98 in federal income taxes. Or a minus 0.01% loss to taxes on her investments. So what's the moral of the story here? Well, here's a couple questions to consider and some food for thought. You know, if you're getting these 1099s and you have numbers all over, right? Let's say you don't pay any attention to everything I just said today, other than you have 1099s with a bunch of numbers in there. Are these all being reinvested, or are you taking this as income? And if you are taking some income, is this being managed within the brackets and things you already have going on? Perhaps you're working with someone and everything's a-okay, but if you have a lot of numbers on these documents that are being basically taxed and you're having everything reinvested, could there be a better way? So perhaps just sitting back and questioning that after you've got all these documents and you've met and filed your taxes for the year, maybe take a look and see if you can position some things a little differently so that next year the numbers maybe look a little bit differently for you and are taxed maybe a little bit lower. Some people have some apprehensions a lot of times with transitioning their investments to a tax-aware strategy. Oh, Brad, I'm going to pay all these gains. I'm going to have all this tax if I start to move things. And I understand that. But there's ways to calculate out like the payback period, right? You're going to pay those taxes every single year going forward. So what's the payback period if you were able to say, okay, if I take all the taxes today and pay them, and I reinvest like this Jane taxpayer, what's my payback? Like, what am I actually going to get back over the next couple of years that I would have paid in tax that I'm no longer paying? And kind of come to that break-even analysis for your transition plan. And then the last is just, are there a lot of unnecessary trading or things going on in your portfolio to generate these taxes and turnover? You can have a high turnover in something that's even tax-aware if the funds are just giving you a bunch of capital gains throughout the year that you weren't really necessarily needing to capture and realize and pay the tax on. So hope this gave you some food for thought and a little deeper dive on that 1099 you get every single year. What do those numbers mean? Why isn't anyone talking about it? And hopefully today you can start asking some smarter questions. So with that, I thank you for joining us. Glad we can continue to help make financial decisions simple for you. If you could smash a button below, we'd appreciate it. Visit our website. And until next time, have a great day.